I've summed up my 5 takeaways and thoughts about this book in this video. I highly recommend you to read the original book of the author. Please share with me your opinion about this book in the comments below. Investing in Bonds for Dummies is a comprehensive guide to help both novice and experienced investors understand the world of bonds. Written by Russel, a seasoned financial writer and investment advisor, the book provides a clear and concise overview of the bond market, including how bonds work, how to evaluate them, and how to create a bond portfolio that meets your investment goals. The book starts with the basics, explaining what bonds are and how they differ from stocks. It then goes on to cover the different types of bonds, including treasury bonds, corporate bonds, municipal bonds, and international bonds. Each type of bond is explained in detail, with examples and illustrations to help readers understand the nuances of each. One of the strengths of investing in Bonds for Dummies is its emphasis on risk management. Wild provides readers with practical advice on how to assess the risks associated with different types of bonds, and how to create a diversified bond portfolio that balances risk and return. He also covers strategies for managing interest rate risk, inflation risk, and credit risk, and provides tips on how to minimize taxes on bond investments. In addition to discussing the basics of bond investing, the book also covers advanced topics such as bond valuation, bond ratings, and bond trading strategies. Wild provides clear explanations of these topics, using real-world examples and scenarios to help readers apply the concepts to their own investing decisions. Another strength of investing in Bonds for Dummies is its focus on practical advice. The book includes a number of helpful tools and resources, such as sample bond portfolios, bond rating agencies, and online bond trading platforms. Wild also provides tips on how to find and evaluate bond funds, as well as advice on how to work with financial advisors and brokers. Overall, investing in Bonds for Dummies is an excellent resource for anyone who wants to learn more about bonds and how to invest in them. The book is written in a clear and accessible style, and covers all the essential topics in a comprehensive and engaging way. Whether you're a seasoned investor or a beginner just starting out, this book is sure to be an invaluable resource for years to come. In Investing in Bonds for Dummies, Russel explains that bonds are a form of debt that investors can buy from organizations that need to borrow money. The borrower, such as a company or government, issues a bond to the investor with a promise to repay the borrowed amount, also called principal or face value, at a predetermined future date, also called the maturity date. During the life of the bond, the borrower pays interest to the investor, which is generally fixed at the time the bond is issued. Bonds have a fixed interest rate, unlike stocks, which do not guarantee any fixed return. There are different types of bonds, including treasury bonds issued by the federal government, municipal bonds issued by states or municipalities, and corporate bonds issued by companies. Each type of bond has its unique characteristics, such as different risks, tax implications, and potential returns. The creditworthiness of the borrower is also a crucial factor to consider when investing in bonds. Credit ratings provided by rating agencies, such as Standard & Poor's or Moody's, can give investors a sense of the borrower's ability to repay the bond. In summary, bonds are a type of debt instrument that investors can purchase from borrowers. They typically offer fixed interest payments and a predetermined future payment at maturity. Different types of bonds come with different risks and potential returns, so investors should consider their investment goals, risk tolerance, and tax situation before investing in bonds. Investing in Bonds for Dummies by Russel explains that there are different types of bonds, each with its unique features and characteristics. One of the most common types of bonds is a treasury bond, which is issued by the federal government to fund its operations. Treasury bonds are considered the safest type of bond because they are backed by the full faith and credit of the United States government. Another type of bond is a corporate bond, which is issued by a corporation to raise funds for business operations. Corporate bonds come with varying degrees of risk, depending on the creditworthiness of the issuing company. High-quality corporate bonds from established companies are typically less risky than those issued by smaller or less established companies. Municipal bonds, on the other hand, are issued by state and local governments to finance public projects such as schools, highways, and hospitals. They can offer tax advantages, as interest earned on municipal bonds is often exempt from federal and state income taxes. International bonds are another type of bond that investors can consider. These bonds are issued by foreign governments or corporations and can offer investors exposure to different economies and currencies. However, international bonds come with additional risks such as currency risk and geopolitical risk. In summary, there are several types of bonds that investors can choose from, including treasury bonds, corporate bonds, municipal bonds, and international bonds. Each type of bond comes with its unique risks and potential returns, and investors should consider their investment goals and risk tolerance when selecting bonds to invest in. Investing in Bonds for Dummies by Russel explains that while bonds are generally less risky than stocks, they still come with some risks that investors should be aware of. One of the most significant risks is interest rate risk, which refers to the risk that rising interest rates will reduce the value of existing bonds. When interest rates rise, bond prices fall because new bonds issued will have a higher interest rate, making existing bonds less attractive. Inflation risk is another risk associated with bond investing. Inflation can erode the purchasing power of the fixed interest payments received from bonds, making them less valuable over time. This risk is particularly relevant for long-term bonds that have a longer time until maturity. Credit risk is another key risk to consider when investing in bonds. Credit risk refers to the risk that the issuer of the bond will default on its debt obligations, resulting in a loss for the bondholder. Bond issuers are assigned credit ratings by rating agencies based on their ability to repay their debts. Bonds issued by highly rated issuers are typically considered less risky than those issued by lower-rated issuers. Liquidity risk is another risk associated with bond investing. This refers to the risk that an investor may not be able to sell their bonds when they want to, or that they may have to sell them at a lower price than they paid. This can happen if there is a lack of buyers in the market, or if interest rates have risen since the bond was purchased. Finally, reinvestment risk is a risk that investors may face when their bonds mature and they need to reinvest the principal. This risk arises if interest rates have fallen since the bond was initially purchased, as investors may not be able to find bonds with the same level of yield. In summary, bond investing comes with several risks, including interest rate risk, inflation risk, credit risk, liquidity risk, and reinvestment risk. Investors should be aware of these risks and consider them when building a bond portfolio. Diversification across different types of bonds and maturities can help to manage some of these risks. Investing in Bonds for Dummies by Russel explains that investors can evaluate bonds by looking at several key factors, such as yield, maturity, credit rating, and bond pricing. Yield refers to the interest rate paid by the bond, expressed as a percentage of the bond's face value. Yield is an important factor for investors to consider when evaluating bonds, as it determines the amount of income that can be earned from the investment. Maturity is another factor to consider when evaluating bonds. Maturity refers to the length of time until the bond's principal is repaid. Bonds with longer maturities generally offer higher yields, but also carry more risk, as there is a longer time for interest rates and other market conditions to change. Credit rating is also an important factor for investors to consider when evaluating bonds. Credit rating agencies such as Standard & Poor's or Moody's assign credit ratings to bond issuers based on their ability to repay their debts. Bonds issued by highly rated companies or governments are considered less risky than those issued by lower-rated entities. Bond pricing is another key factor to consider when evaluating bonds. Bonds can be priced at a premium or a discount to their face value. A bond priced at a premium will have a price higher than its face value, while a bond priced at a discount will have a price lower than its face value. Bond pricing is affected by many factors, including interest rates, credit quality, and time to maturity. Other factors to consider when evaluating bonds include callability, liquidity, and tax implications. Callability refers to the ability of the issuer to redeem the bond before its maturity date, which can impact the investor's potential returns. Liquidity refers to the ease with which the bond can be bought or sold in the market. Finally, the tax implications of bond investing should also be considered, as different types of bonds can have different tax treatment. In summary, investors can evaluate bonds by looking at several key factors, including yield, maturity, credit rating, bond pricing, callability, liquidity, and tax implications. By understanding these factors, investors can make informed decisions about which bonds to invest in and how to create a bond portfolio that meets their investment goals and risk tolerance. Investing in Bonds for Dummies by Russel explains that bond funds are an easy way for investors to diversify their bond holdings. A bond fund is a type of mutual fund that invests in a portfolio of bonds with the aim of generating income for its investors. Bond funds can be managed passively or actively. Passive bond funds track a market index, such as the Barclays Aggregate Bond Index, and seek to replicate the performance of that index. Active bond funds, on the other hand, are managed by a professional portfolio manager who makes investment decisions based on market conditions and the issuer's credit quality. One of the benefits of investing in a bond fund is that it offers investors access to a diversified portfolio of bonds. This can help to reduce the risk of individual bond defaults and interest rate changes. Bond funds also offer investors the ability to invest in bonds with smaller amounts of money, making them more accessible for individual investors who may not have the funds to purchase individual bonds. When selecting a bond fund, investors should consider several factors, including the fund's investment objectives, fees, and past performance. The investment objective of the fund should align with the investor's investment goals and risk tolerance. The fees associated with the fund, including the expense ratio, sales charges, and transaction costs, can impact the investor's potential returns. Finally, past performance can provide an indication of how the fund has performed in different market conditions, although past performance does not guarantee future returns. In summary, bond funds are a convenient and accessible way for investors to diversify their bond holdings. Investors should consider several factors when selecting a bond fund, including the fund's investment objectives, fees, and past performance, to ensure that it aligns with their investment goals and risk tolerance. Investing in Bonds for Dummies by Russel explains that creating a diversified bond portfolio is an essential part of bond investing. A diversified bond portfolio can help to reduce the risk of individual bond defaults and interest rate changes, which can impact an investor's potential returns. To create a diversified bond portfolio, investors should consider several factors, including the type of bonds they invest in, the issuer's credit rating, and the maturity of the bonds. Investing in a mix of different types of bonds, such as treasury bonds, corporate bonds, municipal bonds, and international bonds, can help to diversify an investor's portfolio. Credit rating is another factor to consider when creating a diversified bond portfolio. Bonds issued by highly rated companies or governments are generally considered less risky than those issued by lower-rated entities. Investors should aim to invest in bonds with a range of credit ratings to balance risk and potential returns. Finally, the maturity of the bonds is another important factor to consider when creating a diversified bond portfolio. Bonds with longer maturities generally offer higher yields, but also carry more risk, as there is a longer time for interest rates and other market conditions to change. Investors should aim to invest in bonds with a range of maturities to balance risk and potential returns. When constructing a bond portfolio, investors should also consider their investment goals and risk tolerance. For example, investors with a longer time horizon may be more willing to invest in longer-term bonds that offer higher yields, while investors with a shorter time horizon may prefer shorter-term bonds that carry less risk. In summary, creating a diversified bond portfolio is an essential part of bond investing. Investors should consider several factors, including the type of bonds, the issuer's credit rating, the maturity of the bonds, and their investment goals and risk tolerance when constructing a bond portfolio. By diversifying their bond holdings, investors can help to reduce the risk of individual bond defaults and interest rate changes, which can impact their potential returns. Investing in Bonds for Dummies by Russel explains that different types of bonds have different tax implications, so investors should be mindful of taxes when investing in bonds. The tax treatment of bond investments varies depending on several factors, including the type of bond, the issuer, and the investor's tax bracket. Interest earned on treasury bonds is subject to federal income tax, but is exempt from state and local income tax. Interest earned on municipal bonds, on the other hand, is often exempt from federal, state, and local income tax, making them a popular choice for investors in higher tax brackets. However, some municipal bonds may be subject to the alternative minimum tax, AMT, or may have taxable portions, so investors should be aware of these factors when investing in municipal bonds. Interest earned on corporate bonds is subject to federal, state, and local income tax, and investors may also be subject to taxes on capital gains if they sell the bond at a profit. Interest earned on international bonds is subject to federal and state income tax, but may also be subject to foreign withholding taxes. Investors should also be aware of the tax implications of bond funds. Bond funds can generate taxable income for investors, even if they do not sell any shares. Investors should be mindful of the fund's turnover rate, as this can impact the amount of taxable income generated by the fund. Finally, investors should consider using tax-advantaged accounts, such as individual retirement accounts, IRAs, or 401k plans, to invest in bonds. These accounts offer tax-deferred or tax-free growth, which can help to minimize taxes on bond investments. In summary, different types of bonds have different tax implications, so investors should be mindful of taxes when investing in bonds. By understanding the tax treatment of bond investments and using tax-advantaged accounts, investors can minimize the impact of taxes on their bond returns. Investing in Bonds for Dummies by Russel explains that bond laddering is a strategy that investors can use to manage interest rate risk and create a predictable stream of income. Bond laddering involves investing in bonds with staggered maturities so that the bonds mature at different times. This allows investors to benefit from the potentially higher yields of longer-term bonds while reducing the risk of interest rate changes. To create a bond ladder, investors should first decide on the length of the ladder and the amount of money they want to invest in each rung. For example, a 5-year bond ladder with $50,000 could involve investing $10,000 in bonds that mature in 1 year, $10,000 in bonds that mature in 2 years, and so on. The ladder can be adjusted to meet the investor's investment goals and risk tolerance. One of the benefits of bond laddering is that it creates a predictable stream of income. As each bond in the ladder matures, investors can reinvest the principal in new bonds with longer maturities, maintaining the ladder structure. This allows investors to benefit from potentially higher yields offered by longer-term bonds while still having access to their funds periodically. Bond laddering can also help to manage interest rate risk. If interest rates rise, investors may experience lower returns on their bonds. However, with a bond ladder, only a portion of the investor's portfolio is affected by interest rate changes at any given time. This reduces the risk of sudden changes in returns that can occur with a portfolio of bonds that all mature at the same time. In summary, bond laddering is a strategy that investors can use to manage interest rate risk and create a predictable stream of income. By investing in bonds with staggered maturities, investors can benefit from the potentially higher yields of longer-term bonds while reducing the risk of interest rate changes. Bond laddering can be customized to meet the investor's investment goals and risk tolerance and offers a practical way to invest in bonds. Investing in Bonds for Dummies by Russel explains that bond investing can be a valuable tool for income-oriented investors, such as retirees, who are looking for a source of regular income. Bonds offer investors a predictable stream of income through interest payments, which can help to supplement retirement income. One of the benefits of investing in bonds for income is that they can offer higher yields than other fixed income investments, such as CDS or money market funds. However, investors should be aware that higher yields often come with higher risks, such as credit risk or interest rate risk. Another factor to consider when investing in bonds for income is the tax implications. Interest earned on bonds is generally taxable, but some types of bonds, such as municipal bonds, may offer tax advantages. Investors should consider their tax bracket and the tax treatment of the bonds they are investing in to maximize their after-tax returns. When selecting bonds for income, investors should consider several factors, including the bond's yield, credit rating, and maturity. Bonds with higher yields generally offer higher income, but may also carry higher risks. Bonds issued by highly rated companies or governments are generally considered less risky than those issued by lower-rated entities. The maturity of the bond also plays a role, with longer-term bonds offering higher yields, but also carrying more risk. Thank you for your interest in this book. Please leave your feedback on these thoughts in the comments below, or just put a like on this video. It will help me stay motivated and make more videos like this. In the description of this video, you may find links where you can purchase this book.